All right, let's put a major financial player through what we like to call the Guru Gauntlet. In this explainer, we're going to rigorously stress test Huntington Bank shares, ticker symbol HBAN, using the absolute legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some modern quantitative modeling. We've got fresh Q2 2026 data, a massive new merger to unpack, and, well, a whole lot of math to do. So, if you're ready to see how the titans of investing would value this regional banking heavyweight today, you are in exactly the right place. Let's get into it.
Here is our roadmap for today's analysis. First, the HBAN company snapshot. Second, the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, DCF and additional models. And finally, a synthesis and final verdict.
Section 1. The HBAN company snapshot. Before we crunch any numbers, we really have to set the macro stage. We're currently looking at the fallout and context of the 2026 Federal Reserve stress tests. Now, as the central bank of the U.S., the Fed's whole job here is to make sure large banks are sufficiently capitalized to withstand severe economic shocks. Under their severely adverse scenario through 2028, they project massive aggregate pre-provision net revenues of $719 billion against staggering credit losses. Any bank we analyze right now is operating under this intense, heavy regulatory microscope where capital safety and soundness are absolutely paramount. It's literally the ultimate stress test environment.
Operating right in the middle of that intense environment is Huntington Bank shares, boasting a massive market capitalization of $35.10 billion. But you know, they aren't just relying on organic growth anymore. Huntington recently closed a massive merger with Cadence Bank, expanding heavily into Texas and the South. This strategic move creates a combined powerhouse with roughly $279 billion in assets, $221 billion in deposits, and nearly 1,400 branches. Suddenly, Huntington is the 8th largest bank in Texas and #1 in deposit market share in Mississippi. This isn't just a regional Midwest bank anymore, guys. It is a top-tier national contender.
Let's look at the core vital stats extracted right from their Q2 2026 earnings and market data. The stock is currently trading around $17.32. They're running at a price-to-earnings ratio of 13.31. Wall Street consensus points to an earnings per share of $1.61 for the current year, and they're paying out a very consistent quarterly dividend of 15.5 cents per share. Definitely keep these numbers in your back pocket because they're the raw fuel for the valuation models we're about to build.
Section 2. The Warren Buffett lens.
Okay, so Buffett looks for a deep economic moat, stellar management, and high returns on equity, all at a reasonable price. So how does HBAN actually stack up on his checklist? First, the economic moat. Thanks to that Cadence merger, they've got immediate scale, securing top positions in highly competitive markets like Texas and Mississippi. That scale is a real, tangible competitive advantage. Second, earnings consistency. In Q2 2026, their net income jumped to $727 million, which is a 39% increase from the prior quarter. Third, management quality. They're successfully navigating the incredibly complex integration of Cadence's systems without widespread customer disruption. That speaks volumes to their operational competence. Fourth, we see a solid 9.3% return on average common equity. And finally, they maintain a very manageable debt-to-equity ratio of 0.73, totally satisfying Buffett's aversion to over-leveraged businesses.
But here's the metric that would absolutely make Buffett smile. While banks inherently have to carry debt just as part of their business model, Huntington's return on average tangible common equity sits at an incredibly strong 15.1%. And get this, if you strip out acquisition-related notable items, it's actually 17.5%. Generating mid to high teens returns on tangible equity while maintaining a safe debt profile, that's exactly the kind of robust capital allocation that signals a seriously high-quality franchise.
Section 3. The Peter Lynch lens.
Peter Lynch, the legendary Fidelity fund manager, focuses heavily on categorizing the type of story a stock tells, looking to find growth at a discount. Under Lynch's famous categorization system, Huntington Bank shares fits perfectly as a stalwart, with a touch of an asset play. Stalwarts are these large, established companies that offer steady, reliable growth and downside protection during recessions. However, through strategic expansions, like deploying a $279 billion asset base and digesting that Cadence acquisition, these stalwarts can unlock hidden value and significantly accelerate their typical growth curves.
And this right here perfectly illustrates Lynch's absolute favorite metric, the PEG ratio. The price/earnings to growth ratio compares the company's PE to its expected earnings growth rate. A PEG of exactly 1.0 means a stock is fairly valued. Huntington is currently sitting at a PEG ratio of 0.81. To a Lynch disciple, anything below 1.0 is a massive flashing indicator, signaling that you are buying the bank's future growth at a definitive discount today.
Section 4. The Benjamin Graham lens.
Graham is the true father of value investing, and he demands a definitive margin of safety. He utilized a strict defensive investor checklist to filter out risky investments before even touching the heavy math. Let's run HBAN through it right now. Adequate size? At $35.1 billion, that's a resounding pass. Earning stability? Net income is up 39% quarter over quarter? Pass. Uninterrupted dividend record? They pay a very steady 15.5 cents per quarter. Pass. Moderate PE ratio? At 13.31, it's well below Graham's typical threshold of 15. Pass. Moderate price to book? With a tangible book value of $9.65 per share, the premium is entirely reasonable for this asset quality. Pass again.
So the crucial point here is the math. Graham's famous intrinsic value formula is the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. To be conservative, we're using the tangible book value of $9.65 and the consensus EPS of $1.61. When we multiply 22.5 by 1.61 and then by 9.65, we get roughly $349.57. Take the square root of that, and it gives us a Graham intrinsic value of $18.69 per share. With the stock currently trading at $17.32, Graham's notoriously strict formula actually shows the stock is undervalued.
Section 5. DCF and additional models.
Now, discounted cash flow models are notoriously tricky for banks because their cash flow is tied up in regulatory capital and loan deployments. However, using a standard bank valuation proxy, we assume an industry average 9% weighted average cost of capital, or WACC, and a pretty conservative 2% terminal growth rate. Looking right at the center of our sensitivity matrix, that baseline projection yields a fair value of $19.10 per share. Even if we dial the growth down or increase the discount rate to 10%, the models heavily skew higher than today's trading price.
And we can back this up when we look at alternative modern models. If we value Huntington simply on a comparable PE multiple against an industry average, closer to 14.5, the implied fair value jumps up toward $23.34. And if we look at the pure Wall Street consensus, which aggregates the research reports of 23 different equities research analysts over the last 12 months, they forecast an average price target of $20.11, giving the stock a solid moderate buy consensus rating.
Section 6. Synthesis and Final Verdict.
When we lay all the frameworks side by side, a remarkably unified picture actually emerges. Benjamin Graham's strict formula dictates an 1869 fair value, offering a 7% margin of safety. Peter Lynch's framework sees a PEG ratio of 0.81, squarely in buy territory. Our baseline DCF model points to $19.10, which is a 9% margin of safety, and the aggregate Wall Street consensus sits at $20.11. Across the board, every single mathematical model suggests that at $17.32, Huntington Bancshares is trading at a definite discount to its intrinsic value.
But listen, a true analyst never looks at the math in a vacuum. The strengths here are undeniable. They've achieved top 10 national scale through the Cadence merger, they're generating a highly impressive 15.1% return on tangible common equity, and they pay a rock-solid dividend. However, the risks are equally real. As we saw from those Fed projections, the macro banking environment is incredibly unforgiving right now. Furthermore, smoothly integrating a $279 billion combined asset base across multiple states is a monumental operational challenge that could easily hit some speed bumps. Which leaves us with a final thought for you to ponder. The models have spoken, and they clearly point to a mathematically driven margin of safety in the stock price today. But as an investor, you have to ask yourself, does Huntington's newly forged massive scale, combined with that incredibly attractive 0.81 PEG ratio, provide enough reward to outweigh the lingering, intense macroeconomic risks hanging over the banking sector right now? That is the ultimate question you've got to answer before adding this one to your portfolio. Thanks for joining us for this explainer, and keep learning.